We are the restaurant brokers, and we sell restaurants.
We started the nation's largest restaurant brokerage firm over a decade ago.
Atlanta, Georgia was our starting point, but our brand is spreading nationwide. We define restaurant brokerage and help buyers just like these.
Our dream, our goal, open up a restaurant, loving life, serving people breakfast and lunch, and then enjoying the rest of the day with them and ourselves.
Buying an existing restaurant, leasing a closed restaurant space, or purchasing a restaurant franchise. We help buyers satisfy their appetite for acquisition.
I'm part of a husband and wife team with this fella.
Working with my wife has been a lot of fun. The ultimate goal for everybody here is to make this work. And because we have different strengths, we bring different angles to the deal.
The process begins with our powerhouse website, WeSellRestaurants.com, where buyers sign online confidentiality agreements and browse restaurants for sale.
Then we send buyers undercover to check out a restaurant and decide if it's the right one for them.
Buyers get our proprietary business analysis tool with all the financial details on the business for sale.
After studying the restaurant inside and out, it's back to our office.
We are deal makers. We write contracts and negotiate terms for buyers and sellers. That's why we sell more restaurants than any other firm in the nation. We are the restaurant brokers. Our name says it all. I'm Robin Gagnon.
And I'm Eric Gagnon, and we sell restaurants. We started the nation's largest restaurant brokerage firm, We Sell Restaurants, over a decade ago. You can find us online at WeSellRestaurants.com.
We're also on your radio once a week with the leading authorities in the restaurant business, talking about those subjects trending in the industry. Tweet your own questions while we're on the air. You know our Twitter handle. It's @SellRestaurants. Post to our Facebook page, facebook.com/WeSellRestaurants. If we don't get to your question, we'll follow up on social media.
Our goal is to satisfy your appetite for acquisition, feed the need for restaurant reality, and serve up a recipe for business success. If you have any ideas or any comments about the show, feel free to send me an email. You can reach me at Eric, E-R-I-C, @WeSellRestaurants.com.
Today we are talking to some franchise brand and industry experts on financing. These funding experts are going to talk to us about the steps you need to go through to get your financial house in order and understand why lending is really that key to expansion. To
start that with, our first guest is Denise Thomas. Denise is CEO and co-founder of Apple Pie Capital, headquartered in San Francisco. Apple Pie Capital is a marketplace lender that provides a fresh, new approach to franchise financing. The franchise loan marketplace enables franchise entrepreneurs to efficiently access the capital they need to start or expand their business. This previously difficult to access asset class of franchise loan investment offers investors the ability to earn attractive risk-adjusted returns with the brands they know and trust. Apple Pie Capital believes in the power of the franchise industry to create economic growth and jobs, and is committed to fueling that growth by bringing market participants together in a whole new way. Denise, we're so glad to have you on the show today.
Well, thank you. I'm very happy to be here.
Great. And our second panelist today is Frank Gallagher, the Senior Vice President and SBA Manager of Franchise Lending at the United Community Bank. United Community Bank is a bank holding company based in Blairsville, Georgia, with $7.4 billion in assets. Their subsidiary, United Community Bank, is one of the Southeast region's largest full-service banks, operating 102 offices throughout the Southeast. The bank provides personalized community banking services to individuals, small businesses, and corporations. Frank joins us as the SBA Franchise Lending Manager. He has more than 15 years of experience in SBA lending, with a focus in the franchise lending space and over 25 years experience in lending to small and middle market companies. Prior to United, Frank served as a regional account manager for CIT and has held positions in risk management, business development, credit underwriting, portfolio maintenance, loan closing, collections, and loan closings. You sound like a money man, Frank. Thanks for joining us.
Thanks for having me.
And finally, we also have Chief Development Officer of FrendData, Ron Feldman. Ron utilizes his knowledge and experience with franchise finance to improve the flow of capital to the franchise community. His efforts to build upon FrendData's financing solutions for franchisors that assist their franchisees with the financing process. Feldman is also a principal at Franchise America Finance and Siegel Financial Group and continues to serve as their chief brand strategist. He is often called upon to be a keynote speaker at franchise-related events and has appeared on television programs championing the cause of small businesses. Feldman has been published numerous times in trade magazines, and he's the instructor of choice and subject matter expert on financing and capital access to the International Franchise Association. Ron, glad to have you here today.
Thanks for having me.
Okay, so we have really such a great, knowledgeable group assembled. So let's just kick this off and ask you, Denise, what are you seeing out there in the capital markets, and what should those folks who are thinking about going to market for capital be aware of in today's marketplace?
Well, what we're seeing is a lot of people are very excited about owning a franchise. So we see first unit, franchisees. We see people who are planning to own multiple units over time or already own a unit. And in each case, the situation is slightly different. In some cases, they don't meet the requirements for bank financing. In other cases, they have a need to plan out over time and use their equity carefully across multiple units, and therefore need a plan and leverage so that they don't commit all of their collateral, for example, to their first unit. And so we work with people on the basis of no collateral requirements. These are personal guarantees only, and that creates a lot of flexibility for the individual. We also see people who need their money quickly because they might lose a location. So with our online and committed investors, we have the ability to fund them within 10 days.
Wow. That is super fast. That's very exciting. So, Frank, you want to weigh in? What are your thoughts? What are you seeing in the industry today?
We have a lot of lenders coming into the franchise space, especially, and primarily what I see is SBA. But what we're seeing is everyone is targeting franchises. They have the buzz, but maybe the expertise is a little slow to the market, and it's really important when you're working in franchise that you're dealing with lenders who really get the franchise lending space, folks that really understand the business model of a franchise and the way franchises come to market. So if you're working with experienced lenders in the space, capital access, it's there. It's just a matter of doing the right things and working with a lender that can really deliver for you.
Okay, just so you know, that's a tweet going out to everybody and following us. Capital access is there. Eric, you had a question.
Yeah, and Ron, tell me how Friend Data fits into this whole model here with this financing piece.
Well, one of the things that lenders need to get their arms around is what the brand metrics are, and that's really what mitigates franchise lending from lending to independent businesses. There's a proven track record in history at the system-wide and brand level that can give a lender an idea of how any unit's going to perform. So FranData is the clearinghouse for all of that information. That we have over 6,000 lenders accessing our franchiseregistry.com website looking for brands to lend to, and what we've seen is a real uptick in interest on the lending side, and on the franchisor side, the banks are calling them again. 5 years ago, you couldn't get a banker to return your call. So we're in that cycle now where money is out there, it needs to be deployed, and we kind of act as the clearinghouse for all of that information. Brands come to us to have reports done so that they can show their stuff to lenders and show lenders that their risk is a better risk than another risk. So it really comes down to looking at the brand as well as the borrower.
I think that is such a critical point, and as we work with would-be franchisors, small folks who are growing, trying to caution them to get that financial house in order and work through a systemic process. It makes a lot of difference if something's on the franchise registry, right, Frank? And you're going to look at them a little bit differently?
Oh, absolutely. The franchise registry is kind of your first place to go to make sure you're working with a concept that that has the wherewithal to get on the registry. Their documents are in order. And one thing, I think Ron was being modest with FranData. The franchise registry is a starting point, and a lot of times, a lot of the concepts will go that extra step with their bank credit report, and that is practically an underwriting for the bank. That is the basis of much of the underwriting a bank will do when they're underwriting a franchise concept. Because like Ron had said, you're not only working with an independent borrower, you're working with that franchise concept. And, in the space, especially franchise, you're looking at a concept with maybe 100, 200, 500 locations. That's a lot different underwriting. You have a lot more basis for your decision than you do for a concept with maybe 20 locations. So, you underwrite to those borrowers differently. You expect a much stronger borrower in those small, unproven concepts, where the bigger, more proven concepts, you're usually more aggressive in your lending criteria.
That's very good information. I think people need to know that, especially people franchisor, people that are looking to get their brands, out for, capital. Now, let me ask you this, Denise. Why are alternative investors interested in lending to franchises? I mean, who are these alternative investors? I mean, who are these people behind the scene here that are putting money up?
Well, there are all sorts, but there are institutions. I don't know if anyone who's listening has followed the trend in the consumer lending space, but if you look at Lending Club and Prosper, they have lent in that space for refinance of credit card debt. They have lent about $9 billion out of $49 billion in the last year. So it is making a big change, and it's because investors are seeking return, and they're not getting return. If you have cash in an account today and you're not in the market, you're getting sub 1% returns on your money and your savings and your 401k. So a lot of people are looking for steady, stable fixed income returns or alternative asset classes to diversify. And this is a very appealing asset class to both institutions, family offices who want to put money to work and also want to do good in society. They want to have their money create jobs. So you see money coming from all different places, but it's real money, and there's a lot of it, and a lot of people are looking simply to get their own returns that they cannot get today.
So, Ron, let me ask you this. Is there one single thing that you can point to that's most important to lenders when they are looking at a franchise loan? Do you have some advice for our listeners there?
Yeah, it's pretty simple. Are you giving them a picture where they're going to get repaid? Lenders it's pretty simple. If you are not showing them that they're going to get repaid in your package, and your package is the most important thing, that's where I was going with it. You need to understand your projections that you've created, your business plan. You need to know those numbers cold. You can't say, my accountant did it for me. That's not going to fly with an underwriter. So just show them they're going to get repaid, give them high confidence in your ability, and that's the package is the most important thing.
Okay.
Good. Now, Frank, from your perspective, now you as a lender, what do you look for in a franchise concept besides the fact that they're everywhere and make a lot of money?
Well, that's a real good start. We generally start with we all have our own personal experiences. So some of these concepts you recognize instantly. Some are new to you, but normally you will start with the FDD and any information you can gather independently about a concept, and then you'll work your way through the FDD bank credit report if it's available. And some of the key things you're looking for are experienced management. You're looking for number of locations. You're looking at the financial metrics, not only of the individual stores, but the franchise concept itself. Because if that concept isn't stable, your thought is, will they be there 3 years from now to support my borrower? So you need to make sure not only does the concept make sense, but the concept is financially strong. You're looking at transfer rates, continuity rates. If you have a concept that has a lot of turnover, that can be a red flag. A concept with low continuity rates, a lot of store closures. It's not always a bad thing, but it's definitely something you want to understand and dig into deeper.
So that's I'm sorry, I didn't mean to cut in there, but that's really interesting, because we just had a situation where someone had a deal under contract, because obviously we're restaurant brokers, so we're on the side where people are buying and then submitting something to lending. The lender was comfortable with it. Everybody was comfortable, but I just had a very astute buyer who went through that FDD with a fine-tooth comb, and he said, wait a minute, the franchisor has got this big multi-million-dollar note payment that has to be made in such and such time period, and I don't see the liquidity to satisfy that. And for that reason, he was like the shark, I'm out, and he walked away. So it's intriguing to me that the same kind of methodology you're applying, that very savvy buyers are now doing that as well. You guys want to weigh in?
Yes, I think that's the FDD and BCR is just the starting place. I think that the going deep and understanding what the brand is doing in its growth plans, its own solvency, and in its own support of franchisees. I think one dimension that we really look for is, what do they do when a franchisee is struggling? What is the support they give them? How do they step in? What type of skin in the game do they have in terms of correcting a situation? We've met some great brands who literally will come in and help a location that's struggling to relocate it. They will even go so far in some cases, and this is somewhat unusual, but they'll actually take over and put a new person in place and pay the bill. These are guarantees that investors look for, and while it is not the primary focus of a franchisor to guarantee the financial outcomes of a franchisee in their network, the level of support they give them is important, and we look deeply at that as well. And then looking at the actual candidate in terms of their financials, their business acumen, their experience, we're going to price more aggressively, in that case lower, for an experienced individual and someone with a great credit score and great history in either franchising and or business management. We also don't try to second guess the franchisor's selection of people, because we've learned that sometimes, the franchisor may not want certain background or experience, even though it may be, in a particular restaurant category. They'd rather they come from, a delivery model, because that is more how the business is optimized. So we pay close attention to the franchisor screen of people.
Very good. Ron, I know you're very involved with the IFA, and I've seen you at every conference is known demand. You're always there and very supportive, and we are also going to attend a lot of these conferences. We see a lot of young franchisors. They're like 3, 4, 5 units, and they're like, if I could get more lending, and the banks, like Frank said earlier, hey, if you're smaller, we're going to put you through the ringer. We're maybe too small to be on the registry yet, but we're working our way there. What advice would you have for young franchisors to be able to have some access to more financing so they can get more franchisees out on the street?
Great question, and I'm just going to go back to we've been on the air now, I guess, 20 minutes, and we've only had about 30 seconds about the borrower.
Yes.
So that tells you where the emphasis from lenders is on franchise lending. It's on the brands.
Right.
So the young and emerging entrepreneur franchisor brands are one of the reasons I really wanted to get involved with FranData, because we can really be of assistance to those brands in giving them a roadmap. You're never too small to be on the franchise registry. With if you have a franchise agreement, you should be on the franchise registry if you think SBA is the right tool for you to use for borrowing for your franchisees. However, If you've only got one unit, I don't know that you really want to have franchisees borrowing money to open a unit, because you don't really have a proven track record. Everything that we've talked about, a bank's going to look at your brand and say, hey, you've got one unit. I can't believe that, that's replicable yet. You need to, I just literally this morning was on the phone with a non-restaurant franchisor, and my advice to them was that for the first 10 franchisees they have, make sure they have all the money and don't borrow a nickel. Not what they want to hear, the emerging franchisors, but that's really what the reality is. If you're in it for the long haul, you cannot let any of your first 10 to 20 franchisees fail. If they are struggling, you need to help them, and if they're struggling so much that they can't help themselves, you need to buy them back. And that's $1 million advice to an emerging franchisor. They don't want to hear it, but that's really what they need to hear. The advice I would give going in is to just have them call our company. We have 15 people in our company that work with emerging franchisors every day and can kind of walk them through the process, and we can definitely help them get themselves to the point where bank financing can become predictable.
I think that is really, really great advice, and I agree with you. That is $1 million advice. So let's switch gears and talk, Frank, about that individual borrower, the loan applicant. When that person comes before you, what can they do to actually improve their borrowing experience, improve their odds of being loaned to based on what they bring to the table?
Sure. I think Ron had hinted to it earlier. Maybe it wasn't a hint, but it's that credit package. It's that package of information you send to your banker, and every banker will tell you what they require to underwrite your loan, and it's in your best interest to send that information and complete paperwork. We're at a point in technology now. It's very easy to scan an entire tax return, all the schedules. What you'll find in underwriting is every time you have incomplete information, the transaction stops. Because maybe something's missing, or you don't understand something because you don't have the complete set of paperwork you need. And every time a transaction stops, you look at it and you think, okay, it's only stopped for a day. Not really, because the transaction is put on the back of someone's desk. They move on to something else, and by the time you get the paperwork back to them, that 3 pieces of paper that you didn't send in with your original application just cost you 4 days.
Oh, please.
In a 5-day business week, right?
Welcome to our world, Frank.
Exactly. So I tell folks, put together, when you start your application, when you start working with the banks or the franchisor, get your financial house in order. Get your paperwork in one place. Spend the weekend in the basement. Get all the documents in one big tote, wherever you need to have it. Get as much of it put together electronically, because the more complete that information is, and I'm just talking the base information, you're going to have fewer questions and fewer requests for additional information. And every question and every additional piece of information you send in after the fact is a delay. It's a built-in delay. So if I've seen transactions, and if you're working with an intermediary that really knows what they're doing, or a borrower who maybe has been through it before, really understands the value of that base information, that
worth its weight in gold.
An underwriter does that first.
Okay.
When I was underwriting, if I had 3 packages on my desk, I'd thumb through them, and guess whose deal was first?
I think mine would have to go to the front of the line, Frank, because as brokers...
and yours, exactly.
We try to put the best package out there. Hang on, we're talking about lenders. This is Eric and Robin Gagnon, the restaurant brokers, the industry leaders in restaurants for sale, franchise restaurant resales, and site location. We'll be right back after this quick commercial timeout.